Hey everyone, this is Kirk here again at Option Alpha. So in this video, I'm going to walk through a live example of a TradeStation assignment that I just got the other day. I promised a bunch of traders in our live office hours Q&A last week that I would be posting this video and going through this live on screen so you guys can see exactly how I manage a assignment of an option contract. It's easy to do. It's totally manageable. You don't need to freak out about it. I hope this video really helps. By the way, I also recorded the last time that this happened with my Tasty Trade account, so that video will be linked right below this one in case you want to watch that one and go through that process. The process is broadly the same across all brokers, just might look a little different for different broker platforms. But this one's going to be focused solely on TradeStation because I was assigned one of my put options in my TradeStation account. So here's how we're going to go through this. First of all, quick assignment notes and reminders. Number one, if you trade options long enough, you're bound to be assigned on a position. It's just the nature of trading. If you're going to trade long enough, you're going to do spreads, you're going to do partial trades where you have a short leg, then you're going to be assigned. It's just part of the process. So early assignment happens, again, only with short option contracts. That's because when you sell a short option contract, you're selling away your right to the choice of of exercising that contract later. So the other person on the other end has that choice, which means you have to deal with the assignment if it comes through. Again, it's totally random from the OCC down to the broker and then random from there. So it's not like anybody's targeting you. It's just part of the process. Sometimes it happens. Remember, long options can be exercised early by you, but again, it's your choice. So your long option contracts are never going to be assigned in the most classical sense, those contracts, because they're going to be exercised by you. And that's going to be your choice. You could do it early or at expiration. If you don't close the contract and it's in the money, your broker will auto-exercise or choose to auto-exercise those contracts for you. So again, that's going to be your choice. You only have to worry about early assignment for the short option contracts that you have. Again, option assignment is 100% manageable. I think a lot of people, when they first get that first assignment, there's a lot of tension, a lot of fear, kind of freak out a little bit. Don't have to do that. Just calm down. Don't freak out. Take your time with this. It's totally manageable. And so again, in this video, I'm going to walk through a live example of an assignment I got recently in my TradeStation account. So let's get started with it. So here's the deal. So this is the email that I got from TradeStation. Got it a couple days ago on Friday. And it basically just says, hey, you have this important message in your account. And then you have a link to this message, the options assignment and exercise. So of course, naturally, what I did is I went over to my TradeStation account and I clicked on the link, and then I got to this notification in my inbox there, which basically says that, hey, they wanted to let me know that my account ending in 7622 had option positions that were assigned in XRT, and it had been adjusted accordingly to long 100 shares. Now, I will say that unfortunately, what they don't do in this email is they don't tell you exactly which option contracts got assigned. So if you have multiple positions, you're going to have to go in and look at those multiple positions and see which contracts physically got assigned. It'd be great if they actually told you, hey, it's the short X strike of X month, right? This makes it, a lot more difficult to kind of noodle around in there if you have multiple positions. On Friday, I did have multiple positions, but today I don't, that I'm recording this. I didn't take action on it right away. I'll tell you why I didn't do that here in a second. But now I only have one XRT position, so it makes it a little bit easier. So when I go in here into my account here, you can see these are all the positions that I have in my TradeStation account. So I'll just kind of collapse a bunch of these down here so you can see all these different positions. But here is XRT. And if I open up XRT, then I see all the positions that I have in XRT. Now, what you can see here for these positions is that if you open up these legs here, what you can see is you can see the listing of the different legs that you have. And these are going to be your live positions right now. So I think what's sometimes a little bit tricky about assignment is that when you open these up and you see these, or you see your P&L for the position, it can be a little bit freak out mode because you're thinking to yourself, wait a second, like this is bigger than the amount of money I should have lost on the position, or it had defined risk or whatever. So it is a little bit confusing. I'll kind of try to walk through it as best I can here. But again, what you need to do is just calm down. We'll go through the math in this together. But right now we're just looking at the actual physical contracts that we have. So you can see for XRT, I've got the 74 put, the 84 call, that is short. And then I've got the 86 long call. And you can see here I've got XRT stock and I've got 100 shares long. So that is going to be the assignment here. So essentially what I'm looking for is I'm looking for that assignment right there. I'm looking for what leg is now the assigned leg that is now converted from the option contract into underlying shares. Now, if you look here at the right-hand side of the P&L column here, you can see the average price here is $76. And so that means that my long 100 shares got into those for an average price of $76. So quick quiz, what does that mean? That means that that's actually our strike price that was assigned. Remember, with a short put option, you're going to be assigned and you're going to be forced to buy stock at the strike price of that short put option. In this case, we have bought stock at $76. So that means our 76 short put is going to be the one that was assigned. Now, if I go back over into my Option Alpha account and I go over to my positions, I can look at open positions, filter by TradeStation. I can see that exact position right here. Now remember, we don't get notified at Option Alpha that your position got assigned. So this is the little bit of a struggle. We wish brokers would notify us of assignments. They don't through APIs. We don't know that these things happen. So for all intents and purposes, we're kind of blind and your positions are blind until you go in and manually override the position, which we'll do here together. So we'll close out the position, override it, get all the data and stats back into Option Alpha so we have everything good to go moving forward. But before we do that, let's just kind of look at the position here as it stands or as it stood here so we get some idea of what we're going to be risking in the position, what the initial credit was. We'll want to take down some of these notes as we go through it. So this was the original position that we had. Again, it was the 74-76 short put spreads and then the 84-86 call spreads to create our iron condor position in XRT. So the only contract that was assigned is, of course, our 76 short put contracts. Remember, the 84s could have been assigned, but they're super far out of the money now because the stock is trading at 63.23 this morning. So those are super far out. They're not going to be assigned. They're worthless. And remember, those long options, those are our choice as to exercise those contracts. But what we want to look at here in the initial position view is we want to look at the trade price so we know how much we got into this position for. So we originally sold this position for 64 cents. So that's really important as we start to total up our P&L for this position. And then if you go down to the bottom here, what I like to look at too is I like to look at the capital at risk, which you can see at two different places. You can see our max potential loss. This is our fixed risk amount of 136. Or if you just hover over the max loss territory on your P&L chart here, you can see it's 136 also. So right now the stock is trading at 68.17 and change. It was been trading lower. It's been significantly lower than where our strikes are. This is the reason that I didn't take action on it right away, is because I knew that this position had the 74 strike long put that was acting as protection. So sometimes if you get an assignment, it's very typical for you to want to quickly act on it. And I'm not saying you do or don't have to quickly act on it. You have to keep the capital in your account to hold the position. But in this case, it's only 100 shares, and I did have the 74 strike long put, which was acting as protection, and it was still a couple days from expiration. So what I wanted to do initially is just give it a little bit of time. Maybe we had a big rally back up, maybe came back into the win zone. That has happened a number of times on assignments before historically. So it's not that you necessarily have to jump to managing the position. You can if you want to, but in this case, I held out because I knew that I had defined risk, that the stock was trading well below my 74 strike put, but that 74 strike put was acting as protection for the position. So it was still a protected position, very much the same as before. It's just the composition of it now converted from a short put to actual physical long shares. Okay. So these are going to be, again, just the important things that we want to take note on. We want to take note not only on the initial credit that we took in, but also on our maximum capital risk to make sure that we get out of this position for about the same risk on the position once we close everything. Okay. So now what we're going to do is we're going to go through kind of what our process is for this position. So again, this is our assignment summary for XRT. We had the 74.76 short puts and the 84.86 calls. We sold this original iron condor for, like I said, a 64 cent credit overall. That's going to be important as we kind of do this calculation and go through things. I was assigned only on my 76 short puts. So now I'm long 100 shares of XRT stock, again at 76. And my long 74 strike put, again, has acted as protection this entire time and has actually gone up in value as it's kept protecting the position, and that's maintained this defined risk profile that we have. So essentially, to unwind the position, and this is the really key thing to do, and you can do this many different ways. I'll kind of go through it here, how I would do it. But to unwind this position, you just need to reverse all of the trades. And I would say only reverse the trades that are worth reversing. So I'll go through this together, but whenever you go through an assignment and you want to remove the position, you just want to peel off the positions exactly how you got the position on and make sure that you get rid of any risk that you have. So I'll do this in groups. I like to do this in groups or think about it in groups. Or batches, like doing the call side or doing the put side, depending on which side you're assigned with. That way you can just take a position side off and then manage the other side separately if you wanted to manage the other side separately or not at all. But I like to think about it as the call side, the put side usually, especially if you're doing iron condors, you would do one batch versus the other, okay? So here's what we're going to do. First thing that we're going to do, and kind of go through this assignment math together here because this is going to be really important. First thing is, again, we're going to start with the actual fact that we sold this iron condor for a 64-cent credit overall. Now, the way that I go through this is I literally bring out my calculator like I'm showing you on the screen, and I calculate it out just like I'm going to show you right now. So I start with the 64-cent starting value. That was our credit. And then what I do from there is the next thing is in my calculator, I subtract, or basically creating a debit for the strike that I had to buy the shares at. So remember, we converted our short put from a short put option into forcefully having to buy shares at $76. Remember, that was that average price. So when you think about it, and this is the way I always think about it in my mind, is I bought shares, which means I outlaid money. I wasn't paid money to buy the shares, right? Because I bought the shares. So I had to outlay money. I had to buy the shares at 76, which means what I need to do in my calculator is subtract from my 64-cent credit $76. So I need to subtract that from my 64-cent credit. That just gives me now a running total that I can start to add up as we go. Now, the next part of this process is going to be, and you can do this in one step or you can do this in two steps, but you basically want to unwind the put side of the trade. So first, or combined together, you're going to sell back 100 shares of XRT stock. We don't have a price for that yet, so I'll kind of get that price as we go through it together. And then you're going to sell your long 74 strike put. Again, we're going to put that in here once we do this. Now, you can do this in one combined order if you want to, which is what I'm going to do. That ensures that you get the price that you're kind of looking for. Or you could do this in an order where this is number one and then this is number two, and you kind of split them up. However you choose to do it, it's totally up to you. I personally like to do this in one combined order, okay? So if I go over to my TradeStation web app, what I'm going to do here is I'm going to go ahead and click on these strikes. So I'm going to click on the 74 strike put. Remember, this one right here, if you just kind of look at it, this one right here, we had like the individual leg price was $68, but now it's gone up in value and now it's worth $469. This makes total sense. XRT has absolutely crashed. This was our 74 strike long put. So of course it's gone up in value. That's what we would kind of expect to see. So I'm going to select that strike, and I'm also going to select now the 100 shares of stock. That's going to give me a combined order, basically a cover order to get out of this position, and then I'm going to hit trade. So that's going to bring up a pricing window. Now, the important thing to note about the pricing window is the limit price that you set. Now remember, in this case, we're going to be selling this position. It's basically selling the position for a negative amount. I know that's a little bit confusing the way that they do it here, but essentially you're unwinding the position for a credit. And that credit we're going to use when we start totaling up our P&L here. So we're still working with this figure in our calculator, but we need to make sure that we sell this position for a price that's reasonable for us. Now, the price that you want to sell this position for, in my opinion, is something as close to 74 as possible. Now, why is it 74? Well, remember, our 74 was our long put option. So if we can sell this for something as close to 74 as possible, which you probably won't be able to sell it for 74 or higher, but as close to 74 as possible, then what that does is that does in fact cap the risk at anything below 74. So the closer you get to 74, the better you are capping your risk at the maximum risk. There's limited slippage in getting out of the position. If, for example, you were to sell back your position for, let's say, $70 net, then what you'd be doing is you'd be taking on and accepting an extra risk in unwinding the position of $4, which we don't want to do, of course. So it's really important when you unwind this position that you unwind the position as close to 74 as possible. Now, you can see right now the position is trading for 73.97, so about $3 under 74, which means that if we took this position now and closed it for 73.97, our max risk would be $3 higher than what we started with on the position. Now, sometimes I'm acceptable to do that because the fees associated with exercising the long 74 strike and converting everything over might be in some cases very, very high. So if you don't want to go through that process with your broker or your broker fees are really high, it might be worth essentially paying a couple of dollars here, if you will, to get the position off. But what we can do is we can actually move this up here to something a little bit closer, maybe say 73.99, and try an order there and see if we can get filled on that position. So I'll go here, enter the information in here, hit send on that order. That order was then sent, so we can go over here to our orders, see if that order got filled, and you can see it did in fact get filled. So we are filled at 73.99, so basically just a penny under 74, which means our max risk was just $1 higher than we originally started on the position. So that's good because that's what I wanted to do. You can always try it. Maybe I should have tried right for 74. I bet I would have gotten filled, but I just want to make sure I got filled here for this video for you guys. And just to show you again, sometimes I do go a penny or two under what the value is to just get the position off and remove the risk on the position, okay? So now we know that we sold this net contract set for $73.99. Now that was actually for us a credit. We got a credit of $73.99 for this position, or getting rid of the call and put side. So what we want to do now in our calculator here is we want to add in that credit. So remember, we started with 64 cents of our original credit. We subtracted $76 because that's how much we bought stock for in XRT. We were forced to buy it at the strike price of 76. And so now what we do here is we add back in our credit of $73.99. And when we add back in our credit of $73.99, you can see we get a net result on the position of $1.37. So $137 was our total loss on the position after accounting for the fact that we had to buy back our position, our short put side, and we did that for a penny less. Now remember, if we go back into our option alpha position, our option alpha position showed that our max risk should have been capped at about 136, but we know that we bought that we unwound that position on the put side for $1 less than fair value. Essentially, we didn't let it go to expiration because we just want to get out of the position. So that's the difference right here. So it's a slight difference here. And usually you can keep this if you force the position out to $1 or $2, it's not going to be something crazy exaggerated. And you don't want to pay for something crazy exaggerated if the market's showing you a crazy price. So for example, if the market was showing me a price for that spread of, let's say, $71.50, I would not do it because you'd be taking substantially more risk than just trying to get the position auto exercised and assigned. So you definitely want to get something very, very close to where it needs to be. That way you can keep any sort of, kind of slippage on exiting the position very, very close. In this case, we kept it to $1, which is totally reasonable for the position. Now, when we go back over here to our orders, sometimes you can see the actual prices of the individual legs that you got into here, but this time we didn't see that with TradeStation. They don't show those individual prices when you do a combined order, so you just know the total, but it'd be safe to assume that you'd sold the stock basically at market price wherever it was, and then you of course sold the option contract for something close to market price to get that net difference here. So when we go back to our slides here, we basically sold back the 100 shares of long stock and the long 74 strike put for a total of $73.99 credit. That was, again, the value there, just a penny off from that. Now let's talk about the call side. So this is the other side of the contract. We haven't talked about this one yet for this iron condor, but because the stock has gone down in value, the call side basically expires worthless. And that's the goal of having an iron condor. We have one side's going to expire worthless, even if the other side is challenged. So for the call side, the 84.86, it's going to expire worthless. It's super far out of the money. There's no value to add or subtract because you don't need to do anything with it. It just expires and is done. Now, if the call side did have some value, so if we go back to our position screen here, you can see this is our remaining position in XRT, which is the 84.86 call spread. Those contracts have no value right now. There's just a penny of value in there just for, purposes of putting something in there. But you can see those 84.86 strikes are all the way up here. There's no chance in the next 3 days or 4 days that it's going to get back up to that level, or very, very unlikely. If you did have a position where you had some value in these contracts, then it would be worth closing out the position and reducing the risk even more and reducing the loss on the position even more. So I have had instances where the call spread side is a little bit closer, or it's been assigned really early in the process and I didn't want to keep it, and maybe you can get some money or value out of that. If you did see some value here that you would want to capture, net value or one of the values of the strikes, then you could close this position out as well and remove the risk. But again, for our purposes here, the call side is going to expire worthless and not really add any additional value. Okay, so the last thing that we have to do here is we have to go back into Option Alpha and we have to basically override this position and take over the management because we already closed it. If Option Alpha tried to close this position and basically say that the strikes don't exist for this position, so even if you had this in your bot, you would get an error message that said, hey, we can't find the position, we don't know it's there. So what you do is you simply go here to override the position. That brings up a dialog box that says, are you sure you want to override the position? Because the bot's going to be no longer available to manage it. We say yes, we do want to override the position. When you override a position, immediately everything goes to zero because we assume that you took over full management of it. We have no knowledge of what you did to exit the position. Now, in this case, we're effectively exited from the position because I made those trades. To remove the put side, the call side expires worthless. So what we're going to do here is we're going to go into edit the position. We're going to actually change the status to closed because we close. And then what we need to do here is we need to put in a closing price. So the closing price that we need to put in here is actually the price at which we unwound the whole position. Now this one can be a little bit tricky, but again, let's go through it together so you can see. But here we'll bring up our calculator. The closing price is not that final negative P&L that we had of $138 or $37, whatever it was. It's actually the price at which we close the position. So in this case, we already had the original credit. We don't need to use the credit to calculate this out. So instead, what we do is we just do the actual transactions that happened off of Option Alpha, and then it will total up our P&L for us. So in this case, the first transaction that happened off of Option Alpha was we had to buy stock at $76. So I do a negative 76. That means that's reflecting our debit that we paid to buy stock at $76. And then I add back to that the credit that we received for unwinding the position that we just did, which was $73.99. And once I do that, then I get a closing price of $201. Now you can just copy this from your calculator, put this into your closing price per contract, and then once we hit save here, put the closing price in as 201. Once we hit save, then you can see that this is reflected, and it did in fact show our correct P&L, which was negative 137. Again, it gives you a little status update here, which shows you that the position was changed from override to close, and the closing price was 201. That's how much we paid to get out of the position net. So the difference between assigning the stock at 76 and how much we got at the $73.99 for reversing the position. You can see the closing price here was 201, so just $1 over fair value, which means that even though we had our capital at risk at 137 or 136, the net closing P&L on the trade was 137. Now what I like to do also in these scenarios is I go in here and I also add in a tag for assigned position. Or there it is, assigned. There we go. I add a tag for assigned. And that just tells me that I have had this position assigned. I can use this when I go through my stats or my analytics later on. I know which positions were assigned or how many positions were assigned over time. So I just quickly add that tag in there. But you definitely want to go through and make sure you edit the position to track the total P&L. This will keep everything square and kind of kosher moving forward with your stats and analytics. But at this point, you're good to go. You're done with the position. The assignment's done. I know I went through this in a lot of detail, but I do hope that it really helped out. And as always, if you have any questions, please let us know. If you like this video, please give it a thumbs up and share it with some of your friends. Help spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.